we are looking at inflation today. A fantastic, fun subject, inflation. You know, we heard the other day that inflation reduced from 11.7% in May this year to 7% in July. But then a lot of you are like, yeah, whatever, yawn. What does that even mean? Why should I care? And I want us to unpack that now. So John, you're going to help us.
Yes.
What is inflation? Why should I even care about inflation? How does it even affect the economy? Is it an indicator at all? You know, what is this boring stuff called inflation? Yeah.
So from GDP, we have the output. And then GDP growth mostly measures the output. So now we have to look at the price because every output has to be priced. So inflation is basically an increase in the general price level. So by general price level, I mean the prices of everything.
Yeah. Goods and services.
Yes, goods and services. So everything from milk to bread, everything that you'd find in common Mananchi's basket at the end of the month, including their bills that they have to pay, electricity, rent. So what we have is a consumer price index that looks at all these goods and services, and it measures this index in relation to a particular year or a particular month. So when we say inflation is at 7.4%, we're looking at inflation in July compared to like July in the previous year. So
oh, I see. So if it's July, it was 11.7. It means that the prices of goods and services in this common basket that each of us have has increased by 11% from July last year. So not from last month, but from July last year, for a whole year.
When you hear inflation, the inflation figures we get, they are a year-on-year comparison. Yes. Yeah.
So that's useful. So then, okay, so now it's 11%. That's high, right? It sounds high because they always say we want to reduce it to a single-digit figure, which means below 10. So if it's 11.7%, so does it mean bread has gone up? But I'm still buying bread at 45 bob. I mean, I don't quite feel it per se. You know, from an investor or investing perspective, what would you say? I mean, how can I take that information and use it for my benefit?
So when you're looking at the general price level, the higher it is, the lower your purchasing power. So if you have, say, 1,000 shillings, and inflation is really high, it means that you will be able to buy less goods than you would if inflation was lower. So as an investor, you want to choose those investments that will help you maintain, first of all, your purchasing power. So you want an investment that will grow in line with inflation, first of all.
At a minimum.
At a minimum, so that you have the same purchasing power. And then you want a premium above that. So as an investor, you should use inflation to choose investments that give you returns above the expected inflation rate, say, in the next year. So if we expect inflation to be at 6% in the next year, it would be wise to choose an investment that has a return that's greater than 6%.
Fantastic. So now the inflation rates are every month. Every single month on a certain Thursday, we get the figure. And so it changes, right? So it came down from 11.7 to 7 to whatever it is going to be this month. We don't know. When I look at an inflation figure and I'm making a decision on what investment to get into, and I need to make sure that at a minimum, I am making at least the inflation rate so that I maintain my purchasing power. Should I look at 1 month, so it's 11%, or should I look at an average, say 2017 average inflation rate? What number should I look like? Because each month there's a different number. So you see, from 11.7 to 7 is a huge range. So in May, I needed to find an opportunity that was at least 11.7% per annum, and that's quite high. In July, I'm okay with 7%. So what should I be looking at when I'm looking at an opportunity to invest in?
I think the best thing, first of all, would be to look at an inflation figure for like an entire year. So I think a starting point would be, let's get an average of like, so far we're at August, but we haven't received August figures. So we can look at an average from January to July, and we can use that to gauge inflation going forward. So going forward, we might get an average of say 9%.
Okay.
And that can be a good basis for you to choose an investment based on that.
Perfect. That's great. Because then sometimes you can panic and it's like just 1 month where it was 11% and you're thinking, oh my gosh, my investment is giving me only 9 or 10%. I'm not doing anything. So if you just look at the average, then you'll be fine.
Yes.
Okay, great. I love that. I hope you've learned something. I have. This is Rina Hicks. If you have any questions, please subscribe to the channel, share and like our page. And ask us any question that you like and we'll be sure to respond. So please stay tuned. We will be looking at more economic data and terms and terminology that, just lingo that is just tough to understand. So stay tuned. This is Rina Hicks and you're on MoneyWise, where we create, grow and preserve wealth.